What is up, everyone? This is the Financial Journey once again, and thanks for joining me in today's video. And as usual, I'm not a licensed financial advisor, so please don't treat the information in this video as financial or investment advice. In today's video, I will show you once again how I was able to manage to collect $1,110 just by selling put options on NIO stock. Previously, I created a similar video where I showed how you can generate passive income from trading NIO stocks. If you haven't seen it yet, please do check out the description below. If you guys are enjoying contents like these, please don't forget to like and subscribe. So let's go now to Questrade, which is my trading platform here in Canada. So as you can see, I entered or executed two NIO trades. One which was executed back in January 13 and another in January 15. So let's take a look at each of these trades and try to understand or dissect the details that went through it. So this first one, I sold 5 put option for NIO with an expiration date of Feb 19, 2021, strike price 46, and I received $151 per contract. So since I sold 5, all in all, I got $755 for this trade. So what this trade means is that if by Feb 19, 2021, if NIO's stock price is below $46, which is my strike price, I will then be obligated to buy 500 shares of NIO at $46 per share. 500 since I sold 5 contracts. And as I mentioned before, one contract is equal to 100 shares. At the time that I made this trade, NIO stock price was trading at $61 per share. As you can see, there was a big discrepancy between my strike price of 46 and NIO stock price at that time, which was $61. But because NIO is one of those stocks with high implied volatility, I was still able to get a good amount for my credit premium for selling the put option. Bear in mind that whenever you sell options in the stock market, whether it's put or call, the implied volatility of the underlying stock has a lot to do with determining how much or how good credit premium you will receive for selling the option. Typically, the higher implied volatility of the stock is, the higher credit premium you will receive for selling. So let's take a look at this other one. I sold similar number of contracts, which was 5. Expiration date was Feb 5, 2021. Strike price was 43. And I received $71 per contract. So since I sold 5, like I said, I received $355 all in all. So again, to summarize this trade, what this means is that if the stock price of NIO falls below 43 at the expiration date of Feb 5, that means then that I will be obligated to buy 500 shares of NIO at $43. So let's just quickly run through the components of an option trade, just because I received a lot of questions from some of you who are not yet familiar with options trading. So unfortunately, this is not the video that will discuss the full details or the full information on how to do options trading. So an option is just basically a contract or agreement between two parties. So there's always a buyer and a seller. So in our case, we are the seller since we are the one selling the contract or the option. And then the next component of an option is the expiration date. So the expiration date is nothing but the end date of the contract. So if you've signed a contract before, whether it's a lease for a property, the contract would always have an end date of when that contract is valid or until when that contract is valid. And in option, there's also strike price. Strike price is nothing but the agreed future price of a stock. So let's say right now Apple is trading at $100. So in an option contract, your strike price could be either higher or lower than the current stock price. And then there is a credit premium. So the credit premium is basically the amount or the payment that you receive for selling the put option. So like I said, in every option, there's always two parties. There's the buyer and then the seller. Since we are the seller, we are the one who is receiving the credit premium, and the buyer pays us a credit premium for every contract that we sell in our put option. When we sell put option, it means that we are obligated to buy the shares when the stock price is less than the strike price at the expiration date. So let's say right now Apple is at $100 per share, right? And we want to sell a put option at expiration Feb 19. So our expiration date, right? So that's one of the components, right? The expiration date. And then the strike price. Our strike price is, let's say, $90. And for selling this put option, we want to receive, let's say, $100 per contract. And then we sold 2 contracts. So all in all, we receive $200 credit premium. Okay? So if by Feb 19, Apple shares is $89 per share, 89 is less than our strike price of 90. So what will happen is now we are obligated to buy 200 shares of Apple at $90 per share. Okay? So that's what's going to happen. If by Feb 19, which is our expiration date, if Apple shares is 89 per share, now 89 is less than the strike price of 90. So now we are obligated to buy 200 shares of Apple at $90 per share because we sold 2 contracts and one contract is 100 shares. So that makes it 200 shares that we need to buy. If Apple is $91, is 90 or above, the option becomes worthless. That means that we keep the credit premium that we received. Which was $200. Now, a lot of you again will ask, why do I do this with NIO? I do this for a couple of reasons. Number one is that I'm bullish on NIO. In my previous videos, I said I have long position on NIO. I'm actually up more than 400% on my NIO shares. I want to add some more NIO shares. But, and there's a but, I want to buy it at a lower price. And again, that lower price is reflected on the strike price of the put option that I sell. Right? Let's say NIO is at $64 per share. And even if I have $6,400 in my account, my thought process is that I'm not just going to spend my $6,400 to buy 100 shares of NIO, right? My thought process is that I want to buy NIO, but not at $64 per share. I sell put option, and I say in my put option that my strike price, for example, is at $46 per share. So my strike price is at $46 per share. That means that if, for whatever reason, NIO from 64, after 1 month or at the expiration date, if for some reason NIO stock price is below 46, now I have to buy 100 shares of NIO at $46 per share, even though the price might be $45 per share at the expiration date, right? But to me, that's all well and good still, because instead of me buying it at $64 per share, now I get to buy it at a lower price at 46, which is okay with me because like I said, I am bullish on NIO. I don't mind adding up to my current position. In fact, I would love to get more shares of NIO, but as I've been saying, just not at the current stock price. So the second reason why I do this on NIO stock is pretty simple. I want to generate additional income. It provides me an additional avenue to generate income. So part of what I said in my first reason is that I want to buy NIO shares at the perfect opportunity. In the meantime, while I'm waiting for that, I am getting paid credit premiums. These credit premiums, these are instantly deposited into my account. And just for this month, the income that I have generated just trading put options on NIO stocks is almost $3,000 now in less than 1 month. $3,000 for me is a big amount, given that I'm not a big investor, or I'm not a big trader. I don't do this for a living. I can buy other equities that I want to buy to continue to grow my account. All the trades or all the put options that I've sold so far, they've all been wins. Thanks for watching my video once again. Please don't forget to subscribe. Thank you.